All right. Today's Wednesday, the 19th of February. This is a recap of the stock market activities today. And folks, I got a good one for you tonight. We're back, baby, after the technical difficulties that we encountered last night. Imagine doing an entire show and then realizing that the mic was off after it's already done. Oops. Anyhow, we got an interesting show here for you folks. We begin, of course, by welcome back everybody from the long President Day holiday, which if you don't live in the States and you're not familiar with it, it refers to the founder. You know, the guy who had hundreds of slaves and hoes around, the OG. And of course, we'll give him a pass on all of these sins because he beat the British. I mean, imagine what this country would be like if the British took over. We'll be all speaking English now instead of American. You know what's interesting, though? Hundreds of years later, our presidents still got servants in the White House. With a slight difference, of course, because the president that we got right now has a former president as his servant. I, for one, cannot wait for this honeymoon to be over, because two egomaniacs will not be able to coexist together amicably. Love will be lost. And speaking of lost love, it wasn't just President Holiday, it was Valentine's Day. Hope everybody got some loving over the weekend and you didn't participate in Red Tuesday, which is, of course, at least from a man's perspective, if you have a bunch of chicks that you're dating at the same time, comes Valentine's Day. Unfortunately, you gotta settle on one and then drop the others. You can't give them all a Valentine's Day. Kind of different for women, though. If you got a bunch of dicks in your list, you can keep them after Valentine's Day. You'll go with your dumb hubby or your boyfriend for Valentine's Day, and then you can keep the others because they don't really care. But it doesn't work the same way for us. And I know what you're going to say, but Mav, my chick is quite defined. She loves me. She's loyal. Listen, I'll bet my entire portfolio that your loyal chick is actually banging somebody else on the side. You just don't know about it yet. Or will bang somebody on the side down the line. Just keep that in mind. It's your turn now. Enjoy it while it lasts. But folks, when we talk about the Trump and Musk spat, which hopefully will come sooner than later, we also have the Powell-Trump spat. Of course, the president wants lower interest rates, and the Fed chairman says, I don't really know what the hell I want. I'm just data dependent. Whatever they give me, the fake data that they give us month to month, I'm just going to follow and react to that data. Which right now, as it stands, after all of the hotter inflation data that we got, the Federal Reserve decided to pause, and now they say, maybe we don't need the cuts. Maybe we're not going to do the cuts. And if inflation gets worse, maybe we're going to raise rates again. Now, this could be, of course, the fight of the century. We wanted on Netflix Live. What if, though? What if we're not going to see the Trump-Powell fight? What if they're going to all come down to the same conclusion? That interest rates should go down. And this is going to be a direct result of some of the president's policies right now. And this is why we go back to the title of the video. Is the president trying to create a fake recession intentionally, as in to increase the recession risk deliberately? And the result that's going to follow from that would be lower rates, one step at a time. See, the Federal Reserve right now is reactive. And we say usually that the Federal Reserve, when it leads, as it did back in Volcker days, usually it ends with success. But when the Fed follows the fake data and follow the lags, it is susceptible to make a lot of mistakes in their policy. And it's evident, of course, with what happened in September of last year, the jumbo cut. We get one fake piece of data in the summer pointing out for a recession and loss in jobs. The Federal Reserve immediately panics, cuts by 50 basis points. The data is negated later on. Did the Fed raise rates to cancel the jumbo cut? Of course not. They cut more. And the result of that, of course, is the revival of inflation, and now they regret it. So when we talk about the Fed being reactive, you know by now, if you've been watching the channel for a while, that we have the duality of the risk. Risk number one is the inflation risk. Risk number two is the recession risk. And the Federal Reserve will react based on which risk is higher at the moment. Right now, for example, we have the inflation risk as the dominant risk. And this is why the Federal Reserve adapted the policy that, well, we don't need any more rate cuts. We're going to pause. And if inflation continues to go higher, then we're probably going to hike rates again. If the recession risk increases, though, and becomes more dominant than the inflation risk, then the Federal Reserve will focus on that as they did last summer, be it the fake data or not fake data. And they're going to respond by lowering interest rates. Now, the problem is what happens if both of these risks increase together, as in stagflation? Well, the Federal Reserve is fucked at that point. And this is why stagflation is the worst outcome. And it seems that we're heading that way. But one step at a time, folks. let's go back to the conditions that we have right now. The Federal Reserve is focused on the inflation risk because it is the dominant one. And the inflation risk, of course, stems from the Federal Reserve's mistake last year by the jumbo cut in September, and then after that, they cut rates even further. That is, of course, causing the inflation risk to go higher. But we also have policies from the White House that is increasing the inflation risk. You can pause here and read this tweet from the president. I think it was yesterday. I mean, who tweets like this? You really think we have the capacity to read all of this? But anyways, if you want to read it, pause it for yourself. But in a nutshell, he's going to do the reciprocal tariffs. If any country imposes tariffs on U.S. goods, we'll impose a similar, if not higher rates of tariffs on them. And that includes, by the way, VAT taxes. He considers that as tariff. That's going to be devastating because we import a lot of stuff and all of that will be tariffed. That's going to lead to higher inflation as the consumer pays more. Many, of course, dismiss the tariff policy as a negotiation tactic. Of course it is. But I said in this channel repeatedly that it's part of the economic dogma of the new president. He's not going to let go of the tariffs because it ain't about just negotiation or getting better deals. It's about a dogmatic kind of thinking, which is we don't need to rely on income taxes anymore for the federal government's revenue. We need to offset that doing lower taxes, and we can offset that by higher tariffs. This is not going to change because, Mexico gave us a better deal or increased the border agent numbers. He's scoring, of course, from the negotiation tactics, but at the end of the day, the tariffs will be imposed. And we got the news that Trump is now threatening 25% tariffs on autos, semiconductors, and pharmaceutical imports. This is not going to subside anytime soon. That's your inflation risk, and that's going to lead to higher interest rates. How can the president offset that risk of higher interest rates? Because he wants lower rates. He wants the cake and eat it too. I want to do tariffs, I want to do tax cuts, but I want lower rates at the same time. Maybe you should manipulate the data in terms of showing us weaker jobs data. And when I say manipulate, it doesn't mean cooking the data. It means reducing the fluff, reducing the excess, and giving us a few readings of bad job creation, perhaps some job losses in the economy, which will lead the Federal Reserve to panic again and keep rates low or lower them even further. One step at a time, once again, folks. If we look at the yearly trend in job creation in the economy, this goes, of course, all the way back to the Biden days, you can see that the pace of job creation in the economy is weak, with the exception of some sectors of the economy. Those are education and health services. We talked about this sector in numerous videos before, that we have an aging population and everybody needs care, so we have to create more and more jobs in the health services sector. But keep in mind that it's going to get hit too. Leisure and hospitality, because of the affluent consumer with a higher stock market able to spend. But in the latest jobs report, we've seen job losses in the leisure and hospitality sector. So that sector is weakening as we speak. But another sector that's been hot, it's the government sector. The government can print as many jobs as they can and waste taxpayer money and fluff up the numbers by saying, yeah, this month we created 200,000 jobs, half of them from government positions. This was the manipulation of the data during the Biden administration. Now we see the opposite. We see the government cutting jobs. One step at a time, we talk about it sector by sector. So when we talk about leisure and hospitality, we have even more bad news. So we already lost jobs last month in leisure and hospitality. And now we get headlines like this. Southwest Airlines to cut 15% of corporate jobs. An unprecedented move to cut costs. So the activists, investors are beginning to get their foot in these companies, and they want to initiate some efficiency by cutting jobs. But it also ties in with all of the government firings that we've been seeing as of late. This is, of course, as a result from the DOGE department led by Elon Musk. They're getting rid of a lot of government employees. Well, guess who does a lot of travel? Government employees, because the taxpayer pays for everything. Well, if you fire these employees, then with the weaker demand for airlines now, as the consumer gets weaker and weaker demand from the government, which kept a lot of things hot in the economy, we begin to see a lot of sectors in the economy, not just airliners, but many more, beginning to weaken. Now, when we talk about health services, which is the hottest job market in the economy, we have mass firings going on in the nation's health agencies. A lot of health workers are being fired. There is threat of canceling some of these departments, including a lot of health agencies, and the jobs that come with them. Then we got another headline. 15,000 IRS workers face potential termination. This is the theft IRS, robbing the taxpayer. Oh, you forgot to pay $50 in your taxes. Let's do penalties on you and ruin your life. Oh, you're a businessman now? Congratulations on your success. How about we rob you more now? How about we punish you for success so we can use the money for useless wars and other garbage, bullshit kind of stuff? And this is why a lot of us support what Doge is doing so far, because they're creating efficiency. They're getting rid of the excess and the fake government jobs and the fake paychecks and the fake government spending that kept the economy intact on paper. But of course, Doge is not without problems. Right now, as I said, it's a gimmick. Whatever cuts they're doing right now, oh, that's cute. They say that we saved $8 billion. The real figure was $8 million. So after all of these firings and all of that efficiency moves that they've done, they were only able to save $8 million. That's it. Meanwhile, we have a national debt in the trillions. Call me back when you begin cutting trillions of dollars of government waste. And that's not going to happen without touching the biggest one of them all, the Landromat, the Pentagon. Now, what comes with it? Will Doge or the White House really touch the true rulers of this country, the military-industrial complex, and the oligarchy? I doubt it. But again, we'll give them the benefit of the doubt for now. So let's recap so far what we just talked about. We talked about the duality of the risk, inflation and recession. We talked about where the inflation risk stems from, Federal Reserve's mistake of cutting too soon, and the tariff policy. There's another secret reason that we're going to talk about in a minute. I think some of you know what that is, but hold that thought for now. Then we talked about the recession risk, which stems from the government efficiency initiatives of cutting jobs. They're going to reduce the hottest sectors of the economy, health and government jobs. What else contributes to the recession risk going higher? How about the fact that we had the consumer being weakened for a while now? Under higher inflation or higher interest rates, the consumer is getting killed down there. But nobody notices because who cares about the poor? Who cares about the middle class? But in reality, all of that is going to catch up with us. The consumer is getting hit pretty hard. The only avenue keeping them alive is credit cards. They have to borrow money and increase their risk and their burden even more. The headline reads, credit card debt hit a record $1.21 trillion. No one should be surprised, experts say. Look at this. Look at this chart. You see the massive increase in credit card balances. So when a lot of folks say, Mav, you said there's a recession going to happen. When is it going to happen? It's not here yet. Why do you think it's not here yet, you moron? Look at the chart right in front of you. We are digging ourselves deeper in debt to kick the can down the road. And I said that repeatedly. I'm going to say it again. The sooner you get the recession, the milder it is. The longer you kick the can down the road, the harsher the recession. It could lead to a depression. It could lead to lost decade. Why? Because you have higher debt in the economy now. And you need one ingredient. I mean, you look at all of this credit card debt. What do you think going to happen when these folks begin to lose their jobs? What do you think will happen to the economy? Keep that in mind. What happens to the lenders who owed all of this debt? The damage increases the longer you kick the can down the road. Let's give you some more details. Credit card balances jumped by $45 billion in the fourth quarter of 24, driven in part by holiday spending and are now 7.3% higher than a year ago. At the same time, credit card delinquency rates remained elevated, quote unquote, according to the New York Fed, with 7.18% of balances transitioning to delinquency over the last year. That uptick could indicate borrowers are having some difficulty repaying. Whoops! They're going to have even more difficulty repaying once they lose their jobs. And all of these bullshitters that you hear on TV and CNBC and the like saying, oh, but the consumer is robust. No, your asshole is robust, not the consumer. When these banksters come on TV, the Bank of America CEO, the biggest moron of them all, comes on TV and says the consumer is robust. They're robust because you fuckers are robbing the consumer by charging higher rates and giving nothing in a high-yielding savings account, quote unquote. They give you, we'll give you 1.5%, we'll give you 2%. And the consumer doesn't know better because they've been living for over a decade now with no interest rates at all. You have your savings, you don't get any return, any yield at all. They don't know better. But with higher rates, if you're charging me higher rates, I want higher rates on my savings. Now we begin to see the damage. The longer the game and the can is kicked down the road, the more evident the damage becomes in the economy. The consumer now with higher debt, higher delinquency, higher inflation again. What is the result? Something like we got in this headline. Retail sales down almost 1% in the month of January. down much more than expected. We had to spend in the fourth quarter borrowing and increasing our debt obligations. We have no capacity to spend anymore. Gotta wait a few months till the paychecks accumulate, and then we can pay back the credit card, at least a portion of it, and resume spending and borrowing again. The cycle ends when somebody loses their job, and we just talked about all of the jobs that are being lost right now. So we go back to the Federal Reserve. Right now, they're focusing on the inflation risk because it is the dominant one at this point right now. What if we begin to see more layoffs by the Trump administration? The assumption is that the recession risk is going to increase and the inflation risk will decrease because the consumer will get weaker and weaker with lesser jobs. And the result will be the Federal Reserve is going to cut rates again, and the economy is going to be able to pull through. Sure, we might lose some jobs here and there, but we're going to pull through because the Federal Reserve is going to lower rates. What if, though, both of these risks go higher together, the inflation and the recession risk? Because the tariffs in the inflation risk are independent of whether we have layoffs or not. They're just going to increase the cost by default. And then you add to that layoffs in the government sector and leisure and hospitality, in the health sector of the economy. Now the recession risk goes along with the inflation risk, and hence we have a stagflation phenomenon. And that would be the worst outcome for both the White House and the Federal Reserve. Now remember the third contributor to inflation. We talked about the Federal Reserve mistake. We talked about tariffs. What is the third one, though? That's the catch. On paper, the Trump policies might sound smart, but this is the missing ingredient. See, the Federal Reserve came out with a big admission this week. Here it is, Fed Bowman. She says high asset prices may have impeded progress on inflation. Oh, you think? Oh, wow. I had no idea. Remember what we said in this channel all along? They will never, ever defeat inflation without crashing the stock market down. There's something called the wealth effect. So long as the stock market continues to be fluffed up higher, we're not going to see significant unemployment to reduce inflation. And we're still going to have corporate spending and affluent consumer spending that will keep inflation intact. When you add it all together, is he really crazy like a fox? Because you're going to increase the unemployment rate, got it. You're increasing the recession risk, but you're not reducing the inflation risk at the same time. You're just increasing both together, aka stagflation. When we talk about asset prices in the stock market, Bank of America came out this week and said that U.S. equities seen historically overvalued. Not just overvalued, historically overvalued. The highest level of valuation since April 2001. When we look at investors, the cash level on the sidelines, it is the lowest in at least 2-3 decades, meaning that everybody's all in equities, meaning that we have any problem in the stock market or the economy, the market will become an ATM machine where cash comes out rapidly. And this is why we say that this crash will be the biggest one of them all, because the amount of wealth transfer will be astonishing. It never happened in the history of mankind. The smartest of them all, Warren Buffett, is dumping stocks, while the retail mom and pops and the pension funds and the retirees continue to buy. Hedge funds are now dumping technology and consumer stocks, and they're buying materials. Why? Because they're betting on a recession where tech and consumer stocks go down. But because of the devaluation of the dollar, we see materials going higher. By the way, that's going to lead to higher inflation. So the combination of both is stagflation. Looking at the market right now, making higher highs, but the breadth is making a negative divergence. All worrisome signs, all saying be careful here. You don't want to be too cocky. And when we see all of the activities that we see with the zero DTEs and the funny games that are being played day to day to keep the index intact, it looks prone to an accident. And that will happen the sooner we begin to realize that the dual risk is moving higher, both of them, inflation and a recession. And the Federal Reserve will be in a position where they don't really know what to do. Do we cut rates to mitigate the recession risk, or do we increase rates to mitigate the inflation risk? They're going to go, of course, with cutting rates, because that's what the Fed is prone to do. They freak out. Every time there's a little bit of a hint of a recession, they freak out. They begin easing the policy. And that, of course, would contribute to higher inflation. Dollar goes down, commodities go higher. All I got to say, folks, interesting times ahead. When you look at the ingredients that we have all together, from complacency to being all in the market, to the smartest investor of them all getting the hell out, to the tariff risk, to the policy from the Federal Reserve risk, the inflation risk, the recession risk, the picture doesn't look pretty good here. And a change of strategy is merited by investors. But unfortunately, as I said, complacency is still dominant. With that out of the way, let's add more color to this conversation by revisiting the market activities today. We begin with the closing of the indices, and here we go. The diamonds closing positive by 71.25 points, or a gain of 0.16%. Rates went down a little bit after the FOMC minutes, and that led the Dow Jones, which tracks a lot of the dividend-paying names, to go higher. But again, sustainability, that's under question. The Nasdaq also flattish, but closing positive, up by 14.99 points, or a gain of 0.07%. The S&P is the leader of the day. This is quite unusual because usually the S&P is between the Dow and the Nasdaq. Why is it leading higher, though? It's an evidence that the majority of the action is being led via zero DTEs on the SPY. We explained that in details in last night's video and in the live stream today. The S&P up by 14.56 points, or a gain of 0.24%. But the Russell 2000, among many other leading indicators, like the bond market, like J&K, like Bitcoin, not really giving us a confirmation that we should be heading higher. The Russell 2000 is negative, down by 0.78 points, or a loss of 0.34%. When we look at the sectors' performances, what do we see here? We see the defensives leading the way: healthcare, consumer defensives, utilities. The laggards: technology, industrials, financials, cyclicals, and metals today, which again tells you that there is a positioning for risk off. And we talked about this in the previous videos. Why is gold heading higher like this, despite the dollar? Why do we see Bitcoin stalling? Why do we see the bond market now coming back down? Why do we see negative breadth in the market? All of these are indicating that we have inherent weakness and we can grind our way higher. But once the dots are connected, you will see an oversized reaction to the downside because the volume is getting lower and lower and lower. It's going to get harder and harder and harder to keep going higher without a catalyst that brings the volume back in the market in the buying side. Keep that in mind. Looking at the breadth, the NYSE 40% advancing, 58% declining, and it's also negative breadth in the Nasdaq, 42% advancing, 55% declining. Let's do the heat map right away. We're looking at the big caps. Amazon still weak from the earnings report. Capital expenditure doesn't make sense, and so is Google, but Google is catching some tailwind from the revival of the quantum computing chip optimism coming from Microsoft. Maybe that's going to last for a few more days in both Microsoft and Google. So we usually do the analysis in the streams every day on the big caps. A lot of folks want to bet against the indices because, the index will go down because Nvidia is weak or Apple is weak or whatever, but you can understand what they've been doing so far is just a rotation between the big caps. So one day you see Apple down, but Nvidia higher. Nvidia down, but Apple higher. Sometimes you see Amazon, Google, Microsoft, Meta down, but Apple, Nvidia going higher. And then you see Apple, Nvidia going down, but Microsoft, Google, Meta going higher. And they keep shuffling back and forth and keeping the indices afloat. So you need all of them to go down together for the indices to go down. And this is why in the stream today I said you're better off picking on the wheat in the big caps rather than picking on the index altogether. And right now with the quantum computing optimism, Microsoft, Google could heat up a little more. Meta is losing momentum as we see in the chart, and we talked about that last week, that we have a rising wedge and it's beginning to break down. There's a lot of questioning about, hey, what about the CapEx plans? Does it really make sense or not? So we could see continuing weakening in Meta. And Apple also, we got the release of the cheaper iPhone today, and you might see sort of sell the news. Nvidia is under threat from the semiconductor tariffs. But Nvidia, in my opinion, will be flat-ish between now and until earnings came out in the end of the month. Once they come out, then we're going to see the move. But right now, I think you might see down days 1%, up days 1%. But all in all, it's probably going to stay in a range. So the focus will be on the other guys. And the question is, what would Amazon do? Because Amazon been heading down, and it might, if it continues to head down again, it could be a sort of offsetting the positive activities in Google and Microsoft. So keep that in mind. That's a dynamic in the big caps. With Palantir going down 10% or more after the bell, we'll see weakening in cybersecurity and in software. So software losing some momentum, but some names are still holding pretty good. But of course, with technology not being favored right now, the asset managers are getting out of technology. You'll see software getting a hit more along with the chips, say, in the big caps. But if there is any dip buying in technology, it will happen in the software because it is tariff immune. And you got to keep in mind that the picture is not all uniformed here, because you look at the NVIDIA, for example, down, AVGO, Taiwan, ARM, these guys are down, but some of these smaller chips like Marvell in Texas, NXPI, ADI, Analog doing pretty good today. And you see some of the manufacturers, equipment like AMAT and Lam still doing pretty good. Data centers, though, big pullback in ANET, and that's impacting some other names negatively like WDC, PSTG, and you see in a minute if we talk about the energy providers for data centers. You have Supermicro, that's a short squeeze phenomenon for now. Looking at financials, weak across the board, few exceptions such as insurance doing okay, but insurance is the defensive within financials. The risk on is regionals, and regionals are down across the board. So this is yet another piece of evidence that today was risk off, not risk on. Risk off means that healthcare dividend paying stocks will do pretty good. So we see some demand in big pharma, J&J, Merck, Gilead going higher again. We see even the dips being bought in UNH, healthcare. Where are you going to go? If you want dividend, you want catalyst that is still intact with government spending. I mean, they might cut some jobs at the end of the day, but they're going to still spend on the pharmaceutical companies. And if there was tariffs on generics coming from China or Mexico or Turkey or whatever, then that's going to be good for the big pharmaceutical companies. So we see healthcare leading the way today, along with other dividend-paying sectors such as utilities. We talked about EIX. It's been on fire. Great buy last week. Whoever brought that up, it was a falling wedge, and we said that it has nothing to do with the California fires. It pays great dividend, and this is why we see demand from investors. Real estate, though, not participating in the dividend-paying sectors because real estate could be under threat if rates continue to go higher. But another sector that pays dividend is consumer defensives, and those are doing okay. You see Coke, PepsiCo, Constellation on the Buffett optimism. The food companies are beginning to rebound again after Conagra yesterday. So long as we see a defensive formation, these guys will be appreciated, but be careful because if bond yields move higher, then you can really appreciate the dividend-paying stocks from a defensive theme, because at that point you got to do a different strategy. With bond yields going higher, you got to look for defensive otherwise. And that might keep healthcare as the only option at that point. Looking at the industrials, we have a mixed picture. So we see weakening in some of the AI plays or the data center plays like VRT, the airliners, mixed picture. You have UAL went higher, but you have other airliners that stalled today because of the government layoffs. The defense contractors, with the bad news coming from the peace deal between Russia and Ukraine, we see some demand showing up again. But be careful, because we're talking now about the Defense Department being cut. Not the Defense Department being cut altogether, but the budget being cut by 8% or so. If that is the case, that's going to impact spending for the Lockheeds of the world and the Raytheons and the Northrops of the world. So you're catching a little bit of a rebound today based on the Ukraine news and the spat between Trump and the Ukrainian clown. But I'd be careful with following the dips here. Raytheon, strongest of the bunch. So if you must follow, you go with Raytheon. We talked about HWM. That's continues to be strong. The growth is amazing. So we're going to continue to hold on to it. But with Palantir down as much as it is after the bell, who knows what's going to happen tomorrow. So I would say keep the position right here in HWM. But you need a hedging plan. Looking at energy, we're not seeing a move in crude oil. So the big guys are still down. But Nat Gas is the one that's heading higher. So we see names like EOG, which is a hybrid play, by the way, for oil and gas. It's a fantastic name. Coterra, EQT, Devon, Oxy, and Uncle Buffett optimism buying more. So we see Nat Gas right now, hot. But my 2 cents is at some point it's going to get way too hot, and we see a rotation into the oil names pretty soon. Looking at cyclicals down across the board, which is not a good sign for the economy, but we just talked about the consumer spending and the risk of layoffs and recession and all of that. And these guys, they're the leading indicators. The DR Hortons of the world, the Lennar, look at Toll, even Toll, which caters to the affluent consumer, down 6% today on awful earnings. So this is the early warning sign that be careful, the recession risk is going to increase dramatically in the next few months. And of course, with housing down, you see Home Depot, Lowe's, all of the home improvement also down with it. The Chinese names are pulling back, Baba, Pinduoduo, and Baidu, but let's wait for Baba. I think we're going to pull back on all the Chinese names, and after that, we're going to begin the bargain hunt in the Chinese names once again. Tesla is an options phenomenon. It goes up and down based on options. Some of the EVs, the Chinese EVs, been pretty good, like XPV, and I think NIO is going to be next. Nothing to see here in the communication services. Meta down. Google might heat up on the quantum computing computing chips. But Netflix, we see some unusual activities in the puts, as in some folks saying, okay, that's enough. Let's book some profits or hedge at least. And besides that, of course, when you see a risk-off sentiment, you see names, high dividend paying names like Verizon and AT&T trading higher. But the risk is, of course, if bond yields go higher, then we don't need them anymore. Looking at the heat map for the ETFs, TLT flattish, so no signal. Yesterday, the market defied the signal from the TLT, which was down. Yields were higher. So now we see kind of hesitation. The risk on yield sensitive like IWM, KRE, all down. XRT, home builders, that's the weak link, of course. Exception is the XBI because the entirety of healthcare caught a bid today. And if we look at the dollar cohort, the dollar was flat-ish, so no major move in gold, silver, or reacting properly. A little bit of a rebound in cryptos, but we have, as you see right here in the internationals, negative reactions across the board. As of the internationals, and what you're going to see in the commodities in a minute, indicating that watch out, the dollar is about to rebound. And if it rebounds, I think it kills the pop in Nat Gas. UNG is hot, Boyle is hot, lots of short covering, and that's leading, of course, the XOP in energy because the XOP has gas over the XLE. So the XOP is leading the XLE. But I think if we see the dollar heading higher, it might derail the rally in Nat Gas. What kind of day it is? It's a value kind of day because we see the IWV, VTV, and dividend-paying names like the SCHD leading the way over the XLK, over the SMH, over the SPY, over the Qs. So it is a sort of a value/dividend kind of day. Moving on to commodities. Because of the bad news that we got from the Ukraine war right now, we thought that maybe we're going to have a deal in Saudi Arabia between Russia and Ukraine. But the talks are not going as good as they're painting, at least right now. We have a spat between our president and the Ukrainian clown who's acting entitled, not realizing that we gave him enough. It's time to wrap it up. As the market realizes that, we see huge short covering happening in Nat Gas. That's, of course, one of the reasons. But the other reason is what we see in the country right here. We see colder temperatures across the board, and that's leading to higher natural gas demand. So you have a lot of short covering going on, and now we're surpassing the previous highs in natural gas. So keep an eye. This is also going to be a contributor to inflation. Other energy commodities moving up, but not enough. Now, if the dollar continues to go down, you're probably going to see a response in crude, and we go higher again. That's going to be an inflationary risk. But honestly, when we look at the other commodities, such as metals, palladium, platinum, copper, silver, are all down today. The grains, which are really sensitive to the dollar, like wheat and soybean oil and corn, all down. You look at the majority of softs, like cocoa, cotton. OJ has its own circumstances, of course, but the bottom line here is a lot of commodities are pointing out to watch out. The dollar might be heading higher in the next move. And this is why we see that a lot of these metals going down. We have positive action, though. Coffee, no stop inside here, continues to go higher and higher and higher. And sugar could be the next coffee. We're keeping an eye. I have a video for you coming out in commodities. We're going to talk about wheat a little more. We'll talk about OJ, but sugar are also going to be included because we're looking for now. A lot of you watched the short that I produced in coffee, the call that we've done last year. And now the question is, what is the next coffee? What is the next commodity that's going to rocket higher? We're going to explore that in that video. Moving on to the options market, the big casino, what do we see here? The volume is getting a little higher than usual. It's concentrated in a few names, of course, Supermicro, NVIDIA, Tesla, Palantir, and Intel. When you see short covering such as in Intel and Supermicro, you see the shorts buying call options to exit their positions, and that leads to exacerbated moves higher, and it also increases the volume. And we see the ratio of calls overwhelming the ratio of puts, as we see in both Intel and Supermicro. Any anomalies in the spread between calls and puts besides these names? So Apple, the majority are calls now, about 70%. The IV rank is not too high, so there is a little bit of, let's say, excessiveness in buying calls. It could lead to squeezes higher, but it also signals that maybe a lot of Johnny-come-latelys heading late the game here to chase the Apple rebound, and that could be indicative of that we're getting closer to the end of the rebound. You see Microsoft, the calls overwhelming the puts today, but that's because we had a catalyst. Microsoft revealed their new quantum computing chip called Marijuana 1. So a lot of folks are excited about that, so we see a lot of call options buying in Microsoft. Meta, we see the spread now going back in the favor of calls, about 62%, so maybe Meta is due for a rebound. Although BABA, we still see excessive call options buying at 72%. The stock is overbought. The IV rank at the 70s. It's not like Meta at the 10%, so It is more susceptible for a pullback, Alibaba, than a lot of the other names that you see here. And HIMS, of course, in that category, HIMS is about, IV rank about 93, and we see 52% of the spread as calls. That's also indicative that maybe today's pop is the top, but we begin to head down from this point on. Celsius is really interesting because it's the same phenomenon, 84, 85% calls versus puts, and we see the IV rank is at 90. So you got to be careful. This move is getting closer to an end. And usually the end of the move is climactic with big gains, 17%, 14%. Grab, we had some call options on Grab. I closed it today because the implied volatility is way too high. And we have about 80% of the spread for calls, and the IV rank is 100%. We have an earnings report coming out soon, so you're going to see volatility crush after that, absent, of course, of a major pop in Grab. So I'm happy with the trade that we've done and out for now. Of course, the talk right now would be Palantir, because Palantir is down about 13, 14% after the bell. We're looking at the puts with the expiration date of this Friday on Palantir. What is the risk right now? The risk is 110. Why? Because this one has the highest number of open interest and it has the highest number of volume. So the assumption is they opened a lot of these by the end of the day, which means that the OI change tomorrow will be huge for the 110 puts. That's probably going to squeeze the market maker to push the tape down closer to 110. Now, if we continue to see sellers and put options buying lower than 110, then we could see an inverse gamma all the way down to 105, where we see the second highest number of open interest. See, the market maker has to hedge, folks. If the market maker sees any signs that the price will be below, in the case of puts, that the price will be below a certain strike, be it the 110 or the 105, or whatever number you see here, that has high open interest and specifically high OI change, because that's new feedback. These are new positions that are opened overnight. You'll see them tomorrow. You'll see the update tomorrow. And my hunch is they'll be huge. The market maker looks at the formation and thinks, I got a hedge because if the price goes below 110 or 105, I'm going to be losing on my shares. So I want to sell now at a price higher than 110, higher than 105. And if these puts expire in the money by the end of the week, my obligation as a market maker is to buy the shares of Palantir or whatever strike that expired in the money. But remember, by hedging, the market maker sold earlier at a higher price. So if they have to buy it at a lower price, they don't give a shit. They'll do it. That's the concept of hedging to the downside. We're all familiar about the hedging to the upside, the gamma squeeze, when somebody buys calls out of the money and the tape moves higher and it gets closer to that strike that folks are buying calls at, then the market maker has to stampede, as we've seen in yesterday's session, the zero DTEs, when there was a stampede to buy out of the money calls. The market maker had to hedge by buying the SPY rapidly at the end of the day. That's called the gamma squeeze. What I just explained to you is inverse gamma squeeze. And of course, with the increased volatility that we've seen in Palantir, the IV, you see the change in these puts. Some folks scored over 1,000% worth of gains of these puts had they grabbed them earlier in the session. Let's do the unusual activities, beginning with the bullish ones. We have RH. A lot of the construction stuff, the home building stuff is not doing pretty good, but somebody sees a positive outcome here for RH, and they bought the 390 calls, and they sold the 450 calls, what we call a bull call spread, for the expiration date of March 21st, spending about $2.2 million. Then we have Microsoft and the optimism of the Marijuana 1 quantum computing chip. They think that the price will go high. And they bought the 450 calls for the expiration date May 16th, 2025, spending about a little over $3.5 million. I don't know about that. I mean, Google had a pump because of the quantum computing chip, and then it frizzled out. So I'm not a buyer here. Then we got the ticker TXN for Texas. A lot of the value chips been holding pretty good, so maybe there's a catalyst coming here for Texas. Somebody bought the 200 calls. We're trading right now at about 197, so we're not far out of the money. 200 calls with the expiration date of next week, February 28, spending about a little over $1 million. And then we have the SHAK, Shake Shack. Somebody see it going higher. Bought the 112 calls for the expiration date, February 21st. This is for this Friday. The price is right now 111, so we're not far out of the money. They spent about $1 million. Then we have the ticker PRGO, calendar call spread for Perrigo. This is really interesting. They bought the 25 calls, they sold the 25 calls, but they bought different expiration dates. This is why we call it a calendar call spread. They bought the expiration date of March 21st, and they sold the expiration date of this Friday, the 21st. Of February. All in all, spending about $1 million. Here's the chart of PRGO. Maybe we're seeing right now a higher low. It's a healthcare name. It pays a fantastic dividend. Maybe it is now heading for a recovery. What I'm highlighting for you also in the vertical lines is the first expiration date. This is where they sold at, the 25. So they think that we're going to trade below 25 all the way till this Friday. And then after Friday next week, we begin to trade above 25. If that is the case, then the trade is going to be profitable. But the downside of a calendar call spread, if we have a move higher above 25 before the expiration date of this Friday, then the trade goes kaput. But it seems that maybe they know what they're doing here. Let's do the bearish unusual activities. How about the VIX? We have calls in the VIX, 17.5 calls for the expiration date of March 18th, 2025, spending about $1.5 million. I think that the VIX is way suppressed right now. It's due for a pop. A lot of the traders are betting either it's going to be in March or April. A lot of call options for these two expiration dates. Then we'll look at another bearish one for DFS, Discover Financial. Somebody bought the 190 puts and they sold the 180 puts. What we call a bear put spread for the same expiration date of March 21st, 2025, spending about $1.75 million. Consumers getting weaker, delinquency is going higher. So do you really want to be in the financials or do you want to bet against them? I think I want to be against them. Then we have sort of a risk-on name such as RKK. This is for Mama Kathy Wood. Now, we just talked about the sector performances, and the message by the market is risk off, not risk on. So risk off is being bet against, and somebody here using it via the 64 puts and the 60 puts for the same expiration date, March 7th, 2025, spending about $1.5 million. Looking at the charts, we begin with the first and most important indicator, which is the VIX 2 hours chart. What do we do here? We talked about this in the morning brief, that we see sort of a sloping line of resistance in the 2 hours. We need to see it breaking above that sloping line for the VIX to catch a bid and for the market to correct. But the message here is, we're at the lows of the VIX. So how low can we go? Can we go lower? The answer is sure, you can go lower. Technically, you can go down to the 14th, the 15th. But my 2 cents, I think that there is at least a cohort of investors who are beginning to notice that the risks are mounting and we're better off hedging. So that could lead the VIX to move higher, make that pop. If it does, you're going to see a flush in the indices. So let's look at these charts. We begin with the SPY and hourly chart. What do we do here? Just like we said yesterday, it is sort of a bull flag-ish that is breaking out. Now consolidating another bull flag. So the assumption is higher we go. And in the hour side, we're not really overbought yet. So the assumption right now, higher we go until what? Until we see a reversal sign. And a reversal sign will be sort of a bearish engulfing candle in the hourly. But for me, the loss of 608 will be indicative of be careful. The action is beginning to reverse. Then, of course, if we close below 608, most importantly in the daily chart, if we take the sloping line of support now, not resistance, but support, if we take it out, then we're going to talk about, okay, it was a false breakout right here. And now we're going to talk about the 50 moving average, and we could see a VIX moving significantly higher, leading to a flush down. But right now, the base assumption is we're above all the numbers that we need to trade above. The hour size is not overbought yet, so the base assumption is higher we go until we get a reversal sign, which we don't have right now. Looking at the E-mini futures, again above the sloping line, and we talked about, hey, if we trade below the sloping line again, that's your confirmation of a false breakout. Of course, it continues to be alarming that we have sort of a sharp rising wedge on lower volume, which usually leads to a big flush down candle that follows. But again, you gotta see it to believe it. You can't really jump the gun and bet against the tape, which is right now in a bullish breakout, until you get signs. You can zoom into, let's say, the hourly chart and follow this one. You got to see some bigger candles that indicate a flush down in higher volume, taking out support lines that the chart prints like right here, such as 6,118.25, then you begin to get confirmations that, okay, the hourly is weakening, which will lead the daily chart to weaken too. Then I have my permission to book profits and begin to buy some puts, for example, a bit to the downside. The Qs, any different from the SPY? No, it's trading at the highs. Still, and consolidation in a bull flag, bullish kind of pattern, and the hour size not overbought yet. It could go to the extremes. So the base assumption right now, higher we go. Until what? Until if we look at the NASDAQ futures daily chart, the risk is, of course, topping candle, rising wedge. We break down. Right now, again, clean up all of this just for perspective. Right now, it's a bull flag pattern. Higher we go. Our size not overbought. But keep in mind, we're kind of breaking out of this wedgish pattern. We get a downside reaction tomorrow. That's going to be a confirmation that, okay, we topped here, and now the search is, can we find a higher low to move higher again? If we, of course, break below the 50, if there's a bigger pullback and we break below the 50, then that's going to be a confirmation that, okay, false breakout, and you're going to see a sharp reaction to the downside after that. One step at a time. Don't jump the gun too early. Wait for the signs on the hourly to lead your decisions on the daily charts. The big kahuna apple, what do we do here? Above all of the moving averages, still consolidating in a bull flag pattern. It's above the important number of 242. So at this, you lose 242. My preference is we lose the 50 days moving average in blue, sitting at about 240 and a half. If we lose that, I got a short trade for you all the way down to the 100 at least. But if we continue to stay here and consolidate, the assumption is we break higher. We're going to re-challenge the highs of this breakdown candle and move higher. My 2 cents would say that you're probably going to see rotations and if Apple maybe to chase Microsoft or Google now. So keep that in mind. But the trigger for a short trade would be losing the 50 days moving average. Nvidia, above all of the moving averages that we need to see, close the gap. So what now? The shorts are done covering now, consolidation up and down all the way till the earnings come out. That's the assumption. So Nvidia is going to get really, really boring in the next few weeks, next few days. The earnings report would be next week, actually. So it's not next few weeks, but next few days. The report comes out on the 26th. Will be a really important day for the market. The second indicator, bond yields. We're not above 4.8 yet, but if we do that tomorrow and the momentum turns positive, forget about it. We're going to challenge the highs here and then the highs from the head and shoulder top. And the market will get the memo that yields are heading higher, and that's going to cause an ugly reaction in the stock market. And you see the winners in the last couple of days, the dividend-paying stocks, even though we have a defensive theme, they're not going to be able to hold. So you look at the Russell 2000 right now, I think we have an energy release, and so long as bond yields continue to go higher, it's going to be an energy release to the downside to revisit this trend line right here. Is there a case for a breakout? Sure, but give me some recessionary data, which we don't have this week. We need to drop bond yields in a significant way for the Russell 2000 to reverse course and turn positive again. But if you look at the MACD indicator, momentum is slipping and it could turn and accelerate to the downside. Another yield-sensitive chart is the XHP home builders. We're below the daily support, so now we get a switch. If we see yields again in the 30, crossing above 4.8, that activates the weekly trade in the XHP. What is the weekly trade in the XHP? It is the premise of a topping and a shoulder. You can take the shoulder right here. If you assume this is a shoulder and this is the head, shoulder, shoulder, head. You break the neckline. Now we have steep declines to come. So you're probably going to go with put options all the way to April, if not even May, to play this trade in the weekly chart. Another risk-on yield sensitive is regional banks, KRE, also showing the same pattern as we see in the IWM, but it is above the 50. It is maintaining a cup and handle pattern, so it is the strongest of the bunch when it comes to the risk-on yield-sensitive charts. Unless we close below the 50, you could argue that this is maybe a bear flag and we close below the 50, sure. Once we take the 50, then the bullish outlook is out of the way and the bearish outlook begins to gather momentum, which means that we're probably going to stop at this point the 100 really close, so we have to look for support below. And I think 60 becomes the important number. What about the risk-off stuff? Yield-sensitive risk-off. We talked about the XLP inverse and shoulder making higher highs above the 50. So if you must chase any yield-sensitive, you go with the defensive for now. But like I said, you cross above 4.8 in the 30-year bond yield, even the XLP will react negative. The third indicator is the dollar, and right now the base premise is another bear flag. Down she goes. But I think that the dollar usually pulls tricks out of its sleeves, and it might actually move higher if we have any freak out about tariffs. That could be the message that we got from the futures market and commodities today, from metals and from the international ETFs. The old man is usually pretty good in predicting where the dollar is going to go, and right now it's just consolidating. So we don't have a lot of certainty, and I think that gold is a little overbought and it's susceptible to lose some momentum, negative divergence in the RSI. So I know that everybody wants to chase gold, but let's see the next leg down in the dollar before we do that. Because my hunch is the dollar is going to rebound, leading gold to move down and giving us a pullback. I mean, maybe you'll get it at a better price. The position in here in the Maverick Wall Street is we stay long, but we get a hedge. We hedge using GDX, gold miners, or SLV puts. What's going on with crude oil? We're waiting for this bearish momentum to turn positive. Bullish momentum, but so long as we're below the 50 days moving average and below the top of the breakdown candle in or around 73. You don't have that confirmation yet. So a lot of folks ask, hey, do I buy the XLE? Do I buy Exxon? You got to have the confirmation here of, I wouldn't say even the 50. I would say closing above the top of the breakdown candle about 73.22. Then I'll be comfortable to say, okay, 75 will be the next stop. And after we pass 75, you're going to see a huge release of energy. So one step at a time, crude is not out of the woods yet. You see even the XLE energy stocks outperforming crude today, but plug in the Bollinger Bands were at the top, and you pull back in crude here, going to take the XLE down. And the majority of the gains in the XLE came on the backs of Nat Gas. And if we look at Nat Gas, it's looking a little excessive here, folks. It's looking as we're reaching the upper Bollinger Bands, and this is why I anticipate that if you made money from Nat Gas, book some profits, wait for a pullback, and then see what happens. The question is, when the money gets out of Nat Gas, where is it going to go? The hope for energy investors would be crude oil or gasoline or Bob, but you don't want the money to stay in the sidelines. So a pullback in Nat Gas could be positive for crude, but we got to see that rotation underway before we make that assumption. Tesla, any update from last night's discussion? No. We got a short from the 50 to the 100. Now we got a rebound. Some of you played the rebound play. Now it becomes, is it really a bull flag pattern? And the momentum turns positive again. Time becomes more important than price. And that means that how long can we stay above 360? The longer we stay above 360, the higher the likelihood that the bull flag is going to break out. But the problem is, what if it is consolidation in the bear flag pattern? And we're just fixing the oversold conditions before we take another leg down, cross below the 100, and close the gap right here. How do we know which one is which? Are we trading above 360 or below 360? Time matters more than the price. We trade for a few days below 360, and the likelihood is we break below the 100 and have that flush all the way here. Bitcoin is not giving us any signal right now, but you see the demand for Bitcoin slowing down, and it's been consolidating for a while. I look at Bitcoin right now. The only use I got for Bitcoin, because it's not breaking above my support or resistance from the weekly chart perspective. So it's not giving me confirmation to do anything about it. But I'm using Bitcoin right now as an indicator to trade the stock market from a day trading perspective. When we see flush downs like this, usually you see the market following after that. Rebounds, comebacks, you see the market rebounding along with that. So in the morning, if you see Bitcoin trading down, that's going to be a leading indicator that be careful. The market is probably going to trade down too. Moving on to the conclusion of this video. What do we have in the economic calendar tomorrow? Initial jobless claims, important, but only if there's an outlier. The Philly Fed Manufacturing Survey, important, but again, it's not the most important region of the country either. We have the Golden Piss from Chicago, Austin Goolsbee, speaking tomorrow. We have a bunch of other Fed zombies. You got the Chair of Supervision. What supervision? Michael Barr, and then you got Governor Kugler. But we also have U.S. leading economic indicators. Nobody has been paying attention to that, so not an important day macro-wise. How about earnings-wise? Yeah, we got some of those. Walmart, of course, is the most important one. Walmart has been on fire. One of the best performers last year and so far this year. Will the outperformance be stopped by fears of lower consumer spending or higher costs from the tariffs? We'll see. Alibaba been on fire, so maybe due for a pullback. But we got some other names that could be important to some of you, like Bookings.com, New Mount, and Cheniere. We'll look at all of these earnings in tomorrow's session. But again, macro and earnings-wise, not really that important. So what's going to be dominant tomorrow? It's going to be two things. It will be number one, the options market once again. Number two would be the sentiment, because we have Palantir down big. Let's see what the retail traders would do. Are they going to get hit hard and get margin called and begin to sell other names to cover for their Palantir positions, or will they buy the dip? The message from the sentiment is important early on in the morning. If they give up and we see Palantir down, that's going to be a leading indicator that it could be ugly for the market, as we see more puts being bought, even at the index level. We watched it today. If you've been in Discord, gave you the updates. If you've been in the stream, I gave you the updates. We'll give you the updates again tomorrow, because it'll be all about zero DTEs and options expiration on Friday. Folks, once again, a reminder, we do have the 50% off the membership on Patreon. Links in the description. Tell your friends, tell your family, and join us, because you got about 9 days left or so. And then the offer is poof, gone. But with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Someday my dream will come. One night you'll wake up and you'll discover it never happened. It's all turned around on you. It never will. Suddenly you are old.
Cinnamon, where you gonna run to? 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 to?